Hi everyone, welcome back to Be Rich. There's a concept in the stock market, something known as the numb market. N-U-M-B, numb, numb meaning not feeling. And I thought I'll talk about that today. I've written a more detailed note on this on my Medium page, which you guys can find and read about it if you want to know more about it. Since this is just a short video, I really can't dive too much into it other than the basic concept. And when we have seen it, and broadly discuss maybe are we suffering from it? Are we in the midst of a numb market? Numb market is what happens when the market seems to be non-reactive to any usual market news. Typically, markets react to interest rates, they react to geopolitical tensions, they react mainly to earnings, company earnings. But of lately, if you've been seeing, somehow the market seems to be quite numb to any kind of seismic event in terms of interest rates, or in terms of geopolitical tensions, or even in terms of earnings. If you see, it's really not tracking how it usually does, how sensitive the market is to all this news. And have we seen this before? Yes, we saw this during the 2008 financial crisis. When the crisis started, the world market, which has a total market cap at around $60 trillion, I would say. This is just an ad hoc number, it's not an exact number. Around $60 trillion went down all the way by around, I could say around 50%, went down to around $30 trillion, leading to a shake in the market. And the US Fed and the other reserve banks across the globe waking up to this financial crisis, which was imploding. And they created something known as quantitative easing, QE. QE had three trenches. It had QE1, QE2, QE3. Then they had the TARP. Then they had all kinds of other programs, America alone, then other countries also had. And around $6 trillion out of was created by the Fed and was pumped into the market. How did the Fed create these $6 trillion? Mainly by willing to buy anything which was available for sale in terms of papers in the market. So Fed stepped into the market and became the primary lender. So anybody who wanted any kind of money could walk up to the Fed, borrow it from the Fed by issuing papers to the Fed, which the Fed in turn bought and gave them cash, and that cash was infused. This $6 trillion, which was infused, was not infused in one day or a single shot. It was infused over a long period of time, a few years. And what led to that was a quick, I wouldn't say recovery, a quick infusion of cash into the market. And most of that cash initially did not make its way into the stock market. Most people used that market, when the money which came in, to pay down debt and close loans. And over a period of time, slowly the market recovered. By 2011, 2012, you saw it recovering. But what happened was, because of all this heavy liquidity in the market, usual market news which was coming did not seem to be perturbing the market, because there was so much of liquidity in the market. And we were living in a zero interest rate environment, and there was very easy cash available for everybody and anybody who wanted to take a loan or take a risky bet. They could borrow money and do it. So a lot of money was flowing into the stock market. So this period of time, the market didn't seem to be reacting to any kind of news other than riding and start at the beginning of a bull run. So this was the scenario. And people call this a numb market because the market does not react to all this, the usual news. Now fast forward. So what happened? Now we have a numb market again is a question. What happened during the pandemic? During the pandemic, most governments, not only the American government, all the governments, leading economies across the globe, all took extraordinary steps to shore up the economies because of the pandemic and the lockdowns which followed. It led to huge supply chain disruptions and job losses. So governments had no choice but to step in and start pumping in cash. Same way as quantitative easing, which was already tried and tested method, and everyone's seen the successful proof of it, how it was able to stabilize the global economy. Most Fed and other reserve banks across the globe fell back on this kind of a system and infused a lot of cash into the system again. During the 2007-2008 crisis, around $6 trillion was infused. This time around in the pandemic, if you take what Americans were the largest shareholders in this cash infusion, and you take Europe, and you take Japan, and you take all the other countries across the globe, if you add it up globally, around $15 trillion was infused. So you can imagine, when $6 trillion was infused in the quantitative easing by America, the implications we saw play out. Now, what happened during the pandemic was governments, to reassure the public and to save the economy, have infused over around $15 trillion of liquidity has been pumped into the system. Last time, a lot of the liquidity was used to closing loans and all that. But this time around, a lot of people had nowhere to spend the money. A lot of people were working from home. So a lot of money was saved. And all this saved money and everything started fueling the inflation. And the supply chain disruption added to supply cut and delays in supply chains. So that also led to further inflation. Then the Fed has started increasing rates. But the problem is the liquidity in the market is so huge. It is being fueling this stock market craze which we're seeing, which has also led to, if you see what we saw last year, where usually in a normal situation, when you have a geopolitical tension like Russia, Ukraine going on, or the Israeli-Palestine conflict going on, or the energy prices going up and down, and there's a looms of recession noise going around, usually stock markets react to this. But because of the incredible liquidity in the market seems to be quite numb to all this. So this is the concept of a numb market. You can read more about this in more detail. I've written my article in the Medium. You can read more about it. In more depth, I've discussed this. But the concept is the market is kind of in a numb state. Like the market is under the effect of a tranquilizer. So it doesn't seem to be taking anything into account. And anything and everything which is being said is being discounted. The latest idea of this discounting is the Fed said it's going to be cutting interest rates, is what the market feels. They have not exactly said that. All they've said is the inflation seems to be under control and they're going to take a pause on it, and maybe there's no more requirement to raise the interest rate, is what they've said. Usually the Fed cuts interest rate only for one reason, which is a reason for a recession or an economic downturn. And usually the symptoms of an economic downturn you can look at is there's economic contraction, there's a rise in unemployment, there's a decrease in consumer spending, there's an inverted yield curve, and maybe there's a decline in business investments across the board, and stock market is very volatile or it's going through a decline. There's a reduction in manufacturing activity, and credit is very difficult to get and it's tightening, and the housing market usually in the US starts slowing down. And all these are confidence indicators, and the Fed usually looks at all these and puts it together in its own methodology and comes to understand if heading towards a recession or any kind of economic slowdown, so they cut interest rates. But if you heard the list I've read out, except for one here and there, most of them in America right now seem to be in the green side, not on the red side. So the Fed I don't think, would be in any urgency to start cutting interest rate. So that being said, how long will this numb market last, or the state of stupor will last, or the state of euphoria will last? I cannot say, I cannot predict. But it cannot keep going on forever until and unless there is some reason for liquidity to be pumped into the global economy again. By the time the quantitative easing and all this stuff which we did for 2008 crisis ended, by 2015-16, and we slowly were looking at stabilizing and moving forward, the pandemic came around. When the pandemic came around, we created even more cash and we have infused even more money. This kind of cash infusion creates something known as a multiplier effect in economics. You can study about it, where the money just not $1 pumped in does not equal $1 of work. $1 pumped into the economy multiplies itself in various forms and fashion. You can Google this and read about it more. I don't want to get into that because that itself will become another video, what economic multiplier is. I hope you found this video interesting. I do hope you find time to read more about it. And it's rather interesting, intellectually, I would say. As an investor, as always, talk to your financial advisors, take your risk assessment into view, and be careful in what stocks and bonds or mutual funds you're venturing into. Be safe out there, and I'll see you in the next one. Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.